Good morning, everyone. This is Amit Pabari, founder and managing director of CR Forex. If you see the table next week, there are few central banks meeting lined up, and all central bank meetings stance will be a key factor which is going to determine outlook on different asset class for coming days. In today's presentation, we are going to cover that. Few months back in the month of January, CR Forex did a webinar. In the webinar, our theme was that interest rate globally has bottomed out, and in 2026 we will see interest rate moving higher. Now let us understand our view of interest rate moving higher is getting a double confirmation and why. Last week IEA have announced that they are going to release highest ever oil reserve of close to 400 million barrels. Now let us understand what impact it is going to have on oil market and what impact it is going to have on interest rate. To give you a perspective in terms of what kind of reserves IEA are holding at this point of time, if you see the table in 2012, when Libya war happened, at that point of time the reserves were close to 4250 million barrels. Currently it is trading at 3750 million barrels, which is approximately 12% lower as compared to 2012. And if you see at current point of time, the reserve release is at the highest level. This is giving us a signal that the energy shock in the global market is at the highest level currently. Now, when IEA is releasing its reserves, it can have two impact. For example, in 2022, when US did the same, at that point of time, crude oil prices have moved lower. But in 2026, we are expecting that as the reserves level are at lower level, probably once the war get de-escalated, all IEA member, specifically US, is going to again come and increase its reserve. The net impact on oil prices will be positive. So basically 40 to 60, which was the range for a couple of years, now the new normal range can be 70 to 90 despite the war getting de-escalated. So basically we can conclude that if oil prices remain elevated throughout the year, then inflation will be back. And once inflation is back, central bank will be sounding on a cautious or hawkish tone. So basically, Australian bank have already started increasing the interest rate. Current market expectation is also that they are going to continue to increase the interest rate in coming days, which will be positive for AUD. Now, as far as Fed is concerned, earlier their tone was that they will be reducing the interest rate. Now we are expecting that they will be changing the tone towards hawkishness and probably which will be supportive for dollar index. European Central Bank likely to go for rate increase, which will be mildly positive for euro, and Bank of England is also expected to pause cutting interest rate, which will be mildly negative for pound. Overall, one thing is very clear that all central banks are going to pause for rate cuts, and gradually that tone will be that interest rates are going to go up in coming year. So now understand what is our outlook on dollar index. Basically, couple of weeks back when dollar index was trading near 97.5 kind of a level, we had given a view that dollar index is likely to move towards 100. That is the first target, and second target is 102. We continue to believe that 99.20 to 99.5 is going to act as a very strong support for dollar index, and gradually it is likely to move towards 102 kind of levels. Now let us discuss outlook on rupee. So the first point is that if dollar index is moving towards 102 kind of a level, it is going to negatively impact rupee. Second negative factor for dollar rupee pair is our dependence on the Middle East. To give you a perspective, 45% of India's crude we import from Middle East. 60% of natural gas is imported from Middle East. Now, as far as fertilizer is concerned, 40% of India's fertilizer is imported from Middle East. Now, it will have a direct impact on our food prices and inflation. Apart from that, 30% of India's remittances are coming from Middle East. So, overall, if we say our dependency on Middle East is on a higher side. And the third negative factor for dollar rupee pair is FIIs have been continuously selling from Indian equity market from 2nd March till the last Friday. They have sold close to 6.5 billion from Indian equity market, which is creating pressure on the pair. From last couple of weeks, we have been suggesting all our clients that there are higher chances that the dollar rupee pair can move towards 92 to 92 and a half levels. Now that level have already come. Going forward, rising dollar index, higher crude oil prices, FIIs selling from Indian equity market. These are the points which is directly impacting dollar rupee pair on the negative side, because of which we are expecting that gradually the pair is likely to move towards 93 kind of levels, saying that any positive news on de-escalation from Middle East or on the war front, the pair can move lower towards 9150 to 9170 kind of levels. Overall, the biasness is on the weaker side. Broader range for dollar rupee pair for coming days is on the lower side, 9150 to 9170. On the higher side, we are expecting it to move towards 93. With this, I will end my today's presentation. Jai Hind. Namaskar. फिर मिलेंगे next week. Thank you.